Good morning, everyone. Welcome to XM Live here in the beginner's room. My name is Gil Paz, and I welcome everybody that is also on the XM platform, but also on YouTube and other social networks. In the next hour, we will talk about the COT report. Now, the problem with the COT report is that it's not published those weeks. Why it's not published? Because there is a US shutdown. What does it mean, a US shutdown? It means the US government, there is a special rule in the United States, and this rule is that the US government is not allowed to make indefinitely debt, new debt. And the representative house and the Senate, they decide what is the maximum of debt. And so they reach eventually, every government, they make more and more debt. Also in the US, they reach the ceiling, and then the House and the Senate, they have to decide about a new ceiling. And if they don't decide about a new ceiling, they don't have money anymore. And that's exactly the case at this very moment. So what we are having is that they can't spend anymore. They had to send many employed people home. And so we are missing this month a lot of economic data. We're missing the job report. We're missing a lot of other reports. And we're missing also the COT report. Again, the COT report, this should be actually the theme of today. Now, because there is no COT report, I will just make you a small introduction what the COT report is, when we will get it back, and then I will have a small presentation about fundamental things that are going on at the markets. And I tell you, a lot is going on. I think we are in a crucial moment, and we could be ahead of a bigger market correction, and especially, I believe, gold and silver are in a bubble. Let me explain why. Okay, so before I go to the fundamental, we will start. I will just explain to you how my trading strategy works. How do I look at the charts? How do I analyze markets? Normally, how do I trade? But again, because of the COT report, I need some adjustments. By the way, this is not the first time that this happens to me, that we don't have the COT report and that there is a US shutdown. We had a very long US shutdown in 2018-19. That was in the first term of Trump. We had also a 16-day shutdown while Obama was president. And it happens around 8-9 times more in the 80s and 90s. So this is not a rare situation, but it's an uncomfortable situation because we as traders, we like to get data, and based on the data, we like to trade. Like we believe the data is distorted, and based on that, we can trade. Of course, people who are using only technical analysis, they will use only technical analysis, and that's fine as well. Me, because I'm a swing trader, I'm not a day trader, I use fundamental data, and again, I use also sentimental data. Let me explain what sentimental data is. Sentimental data is looking at the behavior of market participants. So look, when I analyze the markets, and here I analyze the markets on the first level, which is fundamentally. Fundamentally means I look what is happening in the economy, and based on what happens in the economy, I try to predict what happens at the markets. Now, the problem with fundamental analysis is it's a very bad timing tool. Like eventually things can happen, but they don't have, of course, but they can happen, but you never know exactly when. But I do the fundamental analysis, and I say, that's interesting to know. It gives me a little bit an orientation point where I am on the world map. It's important for me to know if I'm, north or south. And so, but it doesn't help me on everyday trading. But again, I will give you a little bit my overall view on what is happening at the market, because now in October, November, December, I think bigger things can happen. Now, the sentimental analysis is the second level of analysis I'm doing. And as I already explained, this is showing how market participants are reacting to fundamental data. Because I give you an example why this is important. Because there might be good economic data coming out. Now, if the market, if people say, okay, there is good economic data, but I see danger ahead of me, maybe I lose my job, there is a lot of pressure at work, maybe they are not so optimistic in spending, even though the economy is doing great. Like they have a great income, everything is great, but they worry about the future, and they say the future can look different. And because they worry, they don't spend. To say, maybe I need the money that I need today, maybe I need to spend it tomorrow, and therefore I save. And because everybody does the same thing, nobody's spending anymore. And then it doesn't matter that you had good economic data. When people stop spending, they will bring a recession. So the market behavior, the reaction of markets might be different than what we see. And I see this as one of a major problem of many beginner traders. They look at the economic calendar, they see, oh, there is good data, and then they go long in the stock market. But that's not enough good data. It's important to see how the market reacts on the good data, because good news, again, maybe the market went up already so much, and now on good news, people say, you know what, that's a good selling point. That's good news. Now I will take part of my profits, and they start to sell. And then you, as a beginner trader, you say that's absolutely not logical. We had good data and the stock market is going down. How is this even possible? But again, things happen. But the sentimental data can explain a lot of those counterintuitive moves that we are seeing in the markets. Now, I use the COT report for sentimental analysis, because in the COT report, I can see what asset managers do, what hedge funds do, and also what retail traders do. And based on what they're doing, I can position myself. So I normally, because I'm a swing trader and not a day trader, I like to be on the side of the asset managers. So if the asset managers are buying gold, I like to buy gold as well, because they buy normally in the long term. And me as a swing trader, I want also to stay a little bit more long. And so I'm looking what they are doing. Retail trader, normally I use as a contrarian indicator. When retail trader become very bullish, I start to worry, because I think if the retail trader even understands that the market is going up, that's it's probably too late, and I should look for the opposite direction. So this is the sentimental analysis. The COT report is published once every week, and the problem with the COT report, as with every tool, there is not only advantages, there is also disadvantages. The problem with the COT report is that it's also not a good timing tool. So we can get a strong signal, but it happens only in 3 weeks, not today. Okay. So what is a good timing tool? Technical analysis. Now, here is the technical analysis. It can show me where is the momentum. So if you get a trend reversal and a strong, we had a strong move down and then suddenly we get a very strong move up, that's a trend reversal. We have new momentum, and this is seen extremely good in technical analysis. Now, I told you everything has an advantage, but also a disadvantage. What is the disadvantage of technical analysis? In my opinion, it's not a good forecasting tool. And I think this is where many, many people are mistaken. They use only technical analysis because they believe, oh, it's a forecasting tool, it's a risk management tool, it's a momentum tool. But in my opinion, again, the forecasting tool, as a forecasting tool, the technical analysis is very limited. Okay, so this is the introduction about how I analyze the markets and how I see each type of analysis. Now, the COT report is published every week when there is no shutdown on Friday evening. when there is no shutdown and when there is no holiday. So when we have like Thanksgiving, normally the COT report is not published on a Friday, but on a Monday. But in general, it's published every Friday evening by a governmental website. You can download the data in Excel and you can see which market participants are positioned how. So it's written, asset managers, so and so many are long, so and so many are short. Leveraged money, long, short. You can see all the positions. You can download the data. And now I don't have it open. I normally download the data, and let me bring in the tool that I'm using. I use Power BI normally to download the data and to make it graphically appealing. So let me just, it's loading. It's a little bit slowly. My computer restarted and therefore I don't have it open, but here we are having it. Okay, so this is how the COT report looks like. So we have the open interest here at the bottom where we can see the volume, and we have the blue line, which is asset managers. The purple line are dealers, and the green line are retail traders. Okay, now again, we don't have it. The newest data is from 23rd of September. We are having now already 21 of October. So this data is already 1 month old, and it doesn't help me so much. So what we do instead is we will start to analyze the market a little bit more fundamentally. And I want to start with the stock market. And I will show you a couple of charts that will show you that the stock market is valued extremely high, and that doesn't mean that it needs to have a crash. It means that if something goes wrong, we can have higher volatility. We are priced in for the best case scenario. Now, if the best case scenario, or even better, so it's not the best, if a good case scenario is priced in, but the best case scenario is happening, stock markets could continue to go up, right? But I want to show you that there is certain risks in the markets. And if something small happens, we could have a major market correction. The first thing are two charts of the Bank of America. And what you're seeing here is that the reserves of portfolios, also for very wealthy clients and also for less wealthy clients, is on record lows. So when you have a portfolio, you are investing, you invest some part of your investments in bonds, some in stocks, and some you have in cash. And cash is here for opportunities, or for if the stock market is correcting, then you can buy more. The interesting thing is there is almost no cash left. You can see here that private clients' cash holding is 10%. And you see here, when you look at the last 20 years, this is one of the lowest level we ever had. And that means there is not a lot of cash that can buy even more stocks. There's just most of the cash is already in the stock market. You can see this also on more wealthy clients, and there the cash holdings are even lower. So that's the first two charts that should explain why stock markets are high. Now, the problem is that the stock market is not only that there is not only little cash left, but it's also leveraged. Leveraged means that people are not only using the money they have, they're using also the money that they don't have. On our trading account, it depends where you are. On the trading account of XM, some will have, again, it depends if you're in Europe or somewhere else in the world, but you get a leverage. Like you can open a deposit with $100, but you can trade with much more. And that is leverage. So you use money you don't have, you actually lend money in order to invest it. And so what you can see here is the margin debt, the level of leveraged money is on a record high. And you can see always when it peaks like this, you see here how parabolic it peaked in 2000, and then we got a huge market correction of 50% until 2002. The same happened in 2007. Again, you see leverage peaked, and it goes in the end parabolic. This is what I want that you see that. It goes parabolic. Let me bring in the pen tool that I can also draw it.